Glad to have you in the Forex Basic Class Season 1.0 by Top Forex Academy. Today, we have an exciting topic to treat with you under Forex Technical Analysis, which is chart patterns. For you to really be a good Forex trader and to conveniently and to independently study the charts and pick out trading opportunities, you need to complement your knowledge with technical analysis, and chart pattern is a must for you. I want you to follow through this video from here to the end of the video because we'll be giving you some expert tips in order to identify these chart patterns and use it to get trading opportunities. Let's dive in. A chart pattern is a graphical representation of price movements by using a series of trend lines or curves. Chart patterns can be described as a natural phenomenon of fluctuations in the price of financial assets that is caused by a number of factors, including human behavior. Chart patterns are a foundation of technical analysis. In technical analysis, chart patterns are used to find trend lines are used to find trends in the movement of an asset price. Why do chart patterns work? Why do chart patterns work? Because the markets are fractal, chart patterns work across all time frames, from weekly time frame, daily time frame, and up to the least time frame. But for the benefit of those learning to be professionals and to be profitable, we would encourage you to use chart patterns on weekly, daily, 4-hourly, and 1-hourly time frame. When you study this, it is called top-down analysis. You study your chart pattern, you see the movement on the bigger time frame like weekly, then daily, you narrow it down, then you corroborate it with your H4, and when you see that the 3 corroborates, you can then be looking at entry opportunities to trade on H1. So that is how to use this time frames combination. And this is called top-down analysis. Fractals refers to a recurring pattern that occurs amid large price movements. Trader psychology is the main driving force of a price action. So these chart patterns work across all assets classes from stocks, bonds, currencies, commodities, and cryptocurrency. Technical traders believe that the price reflects all fundamental information, including market sentiments and perceived fair value. The most basic chart pattern is a trend line. So you need to be able to draw trend lines in order for you to see through where the market is going. A trader armed with the knowledge required to recognize patterns along with the skills to apply them to their trading, to their decision-making process can increase their odds of anticipating the price to their decision-making process can increase their odds of anticipating where the price will move next. The skill required to interpret the chart patterns correctly takes practice and commitment to acquire. So I give it that if you can be practicing this chart pattern every day, you go to your bigger time frame, like the weekly time frame, the daily time frame, the 4-hourly and the 1-hourly time frame, and you check the pattern, check what is going on. And if you can study that and you write it down in your jotter, you can call that your trading journal. Just write it down, what you can see. Go to a particular market, maybe GU, EU, JPY, or you can even go to all the first five or you can even come to the first 5 pairs that were treated during understanding basic of Forex. That's the GU, EU, EJ, US, USD, Swiss. That's the cable, fiber, UP, Swiss, Aussie, and Loonie. If you can come to these first six pairs and check their charts one after the other, from weekly to daily to hourly, and then you will be able to acquire mastery of how to see charts, how to understand price movements, and you can do this in the whole week, second week, and your eyes will be open to what other traders that are seen in the market, and your eyes will be open to clear market movement that is happening every day in the Forex market. Three broad categories of chart patterns are continuation patterns, reversal patterns, and bilateral patterns. The continuation signals an ongoing trend will continue, as the name implies, while reversal chart patterns indicates that a trend may be about to change direction. Bilateral chart patterns let traders know that the price could move either way, meaning the market is highly volatile. Now, let's move to types of chart pattern. We'll be treating about 10 types of chart pattern. For all these chart pattern, you can take a position. For all these chart pattern, you can take a position with CFDs. This is because CFDs enables you to go short as well as long, meaning you can speculate on markets falling as well as rising. You may wish to go short during a bearish reversal or continuation, or you go long during a bullish reversal or a bullish continuation. Whether you do so depends on the pattern and the market analysis that you have carried out. The most important thing to remember when using chart patterns as part of your technical analysis is that they are not a guarantee that the market will move in that predicted direction. They are merely an indication of what might happen to an asset's price. So let us look at 10 types of chart pattern. The first on the list is the head and shoulder. Now, the head and shoulder is a chart pattern in which a large peak has a slightly small peak, on either side of it. You can see the large wick here. Traders look at the head and the shoulders pattern to predict a bullish to bearish reversal. Typically, the first and third week will be smaller, and the first and third week will be smaller than the second, but they will all fall back to the same level of support, otherwise known as the neckline. Once the third peak has fallen back to the level of support, it is likely that it will break through once the third peak has fallen back to the level of support, it is likely it will break through it into a bearish trend. The next is double top. This double top indicates reversal or rejection of price action towards the upside. Once that happens, you begin to anticipate markets or price. You begin to anticipate price of the market moving towards the what? Downward side. Just as we're seeing here. Now it moves to the downside and breaks through the neck, and they permanently go down. The next on the list is double bottom. Just as we have indicated in the double top, a double bottom chart pattern indicates a period of selling causing an asset's price to drop first below a level of support, just like this. It will then rise to a level of resistance before dropping again. Finally, the trend the trend will reverse and begin a upward movement as the market becomes bullish. So this means that a double bottom is a bullish reversal pattern because it signals the end of a downward trend and shifts towards an upward trend. Now, this is a what? A round bottom. You can see the round bottom here. So now we treat a round bottom. It is possible to interpret a round bottom chart pattern as either a continuation or a turnaround. For instance, during an uptrend, the price of the commodity temporarily declines before recovering and continuing to rise. This is consistent with the bullish uptrend. If an asset's price was falling in a bearish trend and then made a round bottom before the trend reversed and enter a bullish trend, this would be an example of a bullish reversal round bottom, as well as shown below. Traders open to profit from this pattern will look to enter long position at the low point in the pattern, halfway round bottom, and to purchase halfway round the bottom, and to purchase additional shares in the breakouts above the resistance. This is a cup and a handle. So you can see that a cup and a handle pattern signals a bullish continuation, which depicts a period of bearish market sentiment, followed by a continuation of the general trend in a bullish direction. Just like this. The cup is reminiscent of the charts pattern called the cup is reminiscent of the chart pattern called the curving bottom, while the handle is reminiscent of the chart pattern called a wedge. The brief retracement that follows the round bottom is called the handle because it stays within the confines of two parallel lines of the price graph. Eventually, the commodity will break out of the handle and resumes an upward trend, as shown here. Wedges. When the price of a commodity moves narrowly between two slopy trend lines, we say that a wedge has formed. Wedge shapes can either rise or descend. To illustrate a rising wedge, imagine a trend line sandwiched between two parallel lines but slopy lines of support and resistance. The support lines is more steepy than the resistance. When the support line is more steepy than the resistance line, when an asset price follows this pattern and then breaks below its support level, it's usually a warning indication that the decline will deepen and become more permanent. Just as we have in this picture, this is a rising wedge. You can see that this is rising, but then at a point it becomes slopy here, and then it ends around here, and you see that as the wedge is ending, there is a selling pressure. As the rising wedge is ending, there's a selling pressure that follows breaking through the supports. A falling wedge has the opposite characteristics. It's falling, but then the wedge is closing up. As the wedge is closing and diminishing, you notice that the resistance is broken to the upper side and the market reverses. The next here and the market reverses. The next here is a pennant and a flag. The next here The next here is pennants and flags. Pennants can be either bullish or bearish, and they can represent a continuation or reversal. The above charts is an example of a bullish continuation. In this respect, pennants can be a form of bilateral pattern because they show either continuation or reversal. When a pennant seems similar to a wedge pattern or triangle, while a pennant seems similar to a wedge pattern or a triangle pattern, which will be explained in the next section, it is important to note that wedges are narrower than pennants and triangles. Also, wedges differ from pennants because a wedge is always ascending or descending, while a pennant is always horizontal. Just like we see here, you can see that this is an example of an ascending triangle. And then you see a chart pattern known as ascending triangle created by drawing a horizontal line across the swing highs representing resistance, and also the ascending trend lines across the swing low representing supports. Ascending triangles often have two or more identical peaks. Ascending triangle often have two or more identical peak highs, which allow the horizontal line to be drawn. The trend line signifies the overall uptrend of the pattern, while the horizontal line indicates the historic level of resistance for the particular assets. So here is a descending triangle, just like in contrast to the ascending triangle. The ascending triangle signifies a bearish continuation of a downward trend. Typically, a trader will enter a short position during descending triangle, possibly with his forex trade, possibly with CFDs or his forex brokers, in attempt to profit from a falling market. Descending triangles generally shift lower and break through the supports because they are indicative of a market dominated by sellers, meaning that successively lower peaks are likely to be prevalent and unlikely to reverse. A descending triangle can be identified from an horizontal line of support, just like this, and the downward sloping line of resistance. Eventually, the line breaks through the supports and the downward trend continues. Last but not the least is the symmetrical triangle. The symmetrical triangle represents the symmetrical triangle pattern can be either bullish or bearish depending on the market. In either case, it's normally a continuation pattern, which means the market will usually continue in the same direction as the overall trend once the pattern has formed. A symmetrical triangle forms when the price converges with a series of lower peaks and higher troughs. In the example below, the overall trend is bearish with a brief upward reversals in the market. As we can see, if you draw this line, you can see that the overall trend is what? Is bearish. However, if there is no clear trend before the triangle pattern forms, the market could break out in either direction. However, if there is no clear trend before the triangular pattern forms, the market could break out in either direction. This means symmetrical triangles are bilateral pattern, meaning they are best used in volatile markets where there is no clear directions of which way an asset might flow, and not of which way an asset might move. An example of a bilateral symmetrical triangle can be seen here, just like this. Is coming downward is coming in a downward trend, is moving in a downward trend, and then starts a symmetrical triangle, and here it's been indecisive for many days. If these candles are daily candle, so let's count the number of days. 1, 2, 3, 4, 5, 6, 7, 8, 9. For 10 days, it is for 10 days, it is indecisive until the 11th day, when a bearish candle comes up at the end of the symmetrical candle, signifying a bearish continuation. To sum up, it's important for us to know that chart patterns are more reliable. Chart patterns shows support and resistance when used in conjunction with other types of technical analysis. Every trader wants to find a confluence before entering a trade. As a rule of thumb, no confluence means no setup and then no trade. In addition to these rules, traders also use chart patterns such as head and shoulders, triangles, and flags to identify potential breakout or reversal. It's important to note that technical analysis is not a crystal ball and cannot predict the future with certainty. However, it can be a useful tool in identifying potential trading opportunities and managing risk. In the next section, we will cover risk management strategies and how to protect your capital while trading Forex. Thank you for your attention. Kindly subscribe to the channel, sign up to our links, and get our promotional bonus. And also you can get $100,000 demo account for your learning. And also you can get 100% deposit bonus for your live account. Visit our website, bit.ly top forex to see a list of our services and products. You can always use them to up your game and hone your skill in Forex trading and achieve your reality. You can also follow our Instagram page, Top Forex Acad. Here are some few self-assessment questions for you to check yourself and gauge your knowledge. We look forward to seeing you on this channel again. We have a list of promotional offers for you, and we are coming up with a challenge very soon to see how much you can gain from Forex. We want to push you harder to see and help you achieve your Forex goals. Until we see you again, share this video, subscribe, comment, like, and share. Thank you. Bye for now.